They told you it was just a precious metal. Right? They told you it was a pet rock. They told you that in a digital world, physical commodities were a relic of the past. But while the world was distracted by Bitcoin, while the media was obsessing over AI stocks, and while the average investor was chasing the latest meme coin, the tectonic plates of the global economy were shifting beneath our feet. Something has happened in the silver market, something that hasn't happened in over 40 years. We are no longer looking at a market driven by speculation. We are no longer looking at a market driven by paper shorts and high-frequency trading algorithms. For the first time in history, the industrial titans, the companies that build the future, have entered the arena, and they aren't playing by Wall Street's rules. Ladies and gentlemen, welcome to the unobtainium phase. Today, Thursday, December 18th, 2025, silver is trading at $67.17. It is an all-time high. It has moved nearly $20 in a single month. To the average person, this looks like a bubble. It looks like FOMO. But to those of us who have been tracking the supply chain data, this isn't a bubble. This is a repricing event. We have uncovered details of a deal that the mainstream financial press completely misunderstood. A deal involving Samsung Electronics. You might have seen the headlines yesterday. Samsung invests in silver mine. It sounds like a small footnote. A tech company buying some rocks. But I am going to show you why that single headline is the checkmate move for the global short sellers. I'm going to take you through the 40-page technical reports. I'm going to show you the battery chemistry that is driving this panic. And I am going to connect it to a massive 129 million ounce debt bomb that is ticking inside the vaults of JP Morgan. This is not a drill. The industrial war for silver has officially begun. Let's start with the news that everyone is talking about. And let's correct the record immediately. If you go on Twitter or YouTube right now, you will see people screaming that Samsung signed a deal yesterday. They are saying this news is the reason the price spiked on Monday. They are wrong, and the truth is actually much more significant. We dug into the filings. We pulled the press releases from the Canadian TSX Venture Exchange. Samsung Construction and Trading, C&T, the trading arm of the South Korean giant, did not sign this deal yesterday. They closed this deal on October 10th, 2025. Why does the date matter? Why am I obsessing over a date on a contract? On October 9th, the silver market broke. Spreads widened, volatility spiked. And quietly, in a boardroom in Seoul and a mine office in Toronto, Samsung was signing the check. They saw the storm coming before the first drop of rain hit the ground. Samsung paid $7 million in an upfront prepayment facility to a company called Silver Storm Mining. This money was specifically designated to restart operations at the La Parrilla mine complex in Durango, Mexico. Now, $7 million might sound like a pocket change to a company like Samsung, but you have to look at the terms of the deal. This is where the devil is in the details. In exchange for that cash, Samsung didn't just get stock. They didn't just get a thank you note. They secured the rights to purchase 100% of the silver, lead, and zinc concentrates produced by that mine for the next 2 years. Let that sink in. 100%. They didn't leave a single ounce for the open market. They didn't leave a single ounce for the COMEX. They bought the entire production run of a mine that hasn't even fully restarted yet. This is a behavior we have never seen from big tech before. Usually, Apple or Samsung or Tesla buys their metal from a dealer. They call up a refiner in Switzerland or a bank in London and say, "We need 50 tons next month." The bank delivers it. Easy. But by financing the restart of a mine, Samsung is telling us something terrifying. They don't trust the dealers anymore. They don't believe the banks can deliver. They don't believe the COMEX has the metal. They are so terrified of a supply chain collapse that they are going directly to the geology. They are paying to dig the hole themselves just to guarantee they have the material to build their products. This is what we call vertical integration out of desperation. And why are they desperate? Is it just for current electronics? No, it's for what comes next. To understand why Samsung is panicking, you have to leave the world of finance and enter the world of chemistry. For the last 10 years, we have heard about the solid-state battery. It's the holy grail of electric vehicles. A battery that charges in 9 minutes, lasts for 600 miles, and doesn't catch fire. Everyone thought it was science fiction. Everyone thought it was 10 years away. But Samsung has been quietly perfecting a specific technology, the silver-carbon Ag-C composite anode. Unlike lithium-ion batteries that use graphite anodes, this new tech uses a distinct layer of silver-carbon composite. Why silver? Because silver is the most conductive metal in the universe. It allows the ions to move at speeds that graphite physically cannot handle. That is how you get the 9-minute charge time. But there is a catch. A massive, expensive catch. According to prototype data and analysis from the Silver Institute, these batteries utilize a staggering amount of silver. Early estimates suggest up to 1 kilogram of silver per vehicle. Now, engineers are working night and day to thrift that down. Maybe they get it down to 500 grams, maybe 300 grams. But let's do the math on the conservative end. Global EV production is heading toward 20 million units a year. By 2030, it could be 30 or 40 million. If just 20% of the global fleet switches to these high-performance Samsung batteries, and let's say they manage to reduce the silver content to 500 grams per car, that is 10 million cars x 0.5 kilo. That is 5,000 metric tons of new silver demand per year. 5,000 tons is roughly 160 million ounces. Do you know what the global deficit was last year? It was around 200 million ounces. If this battery tech goes mainstream, and Samsung has announced mass production targeting 2027, it effectively doubles the structural deficit overnight. There's not enough silver in the ground to feed this beast, and Samsung knows it. That is why they bought the mine. That is why they locked in the contract in October. They are doing the math that the analysts at Goldman Sachs are ignoring. They are realizing that if they don't own the metal, they don't have a product. This transforms silver. It is no longer just a precious metal or a monetary metal. It is becoming a strategic energy metal. Comparing silver to Bitcoin right now is like comparing food to a digital receipt for food. Bitcoin has value as a monetary network, sure, but Bitcoin does not have a floor. If sentiment collapses, Bitcoin goes to zero. Silver has a utility floor. Even if every investor sells, Samsung must buy. Tesla must buy. The solar industry must buy. At $67, silver is expensive for an investor. But for Samsung, if a smartphone costs $1,200 or an EV costs $50,000, do they care if the silver inside costs $50 or $100? No, they care if they can get it. The price is irrelevant. Availability is everything. So we have the industrial panic on one side. That explains the floor. That explains why the price won't crash. But what explains the rocket ship to $67 and what explains the violence of this move? That brings us to the short squeeze, and not just any squeeze. We are tracking rumors of the largest bank default in the history of the commodities markets. For months, analysts like Cyril Joubert and the team at Goldbroker have been tracking a massive anomaly in the lease rates. Here is the intel. Back in October, the same month Samsung bought the mine, JP Morgan reportedly entered into a massive lease agreement with the Industrial and Commercial Bank of China, ICBC. The rumor is that JPM leased 4,000 metric tons of silver, that is roughly 129 million ounces. Why would JPM lease metal from China? Because the West was dry. They needed physical bars to deliver against contracts in London and New York to prevent a default back in the autumn. They borrowed from Peter, China, to pay Paul, the COMEX. But a lease is a debt, and debts have due dates. The terms of that lease were reportedly 3 months. October, November, December, January. We are sitting here on December 18th. That means JP Morgan has approximately 2 weeks to return 4,000 tons of silver to the Chinese. If they don't have the metal, they have two options. Extend the lease. This is getting wildly expensive. Lease rates have jumped 40%. It's like paying credit card interest on a $1 billion loan. Default? They admit they don't have it. Now, do you want proof that this isn't just a conspiracy theory? Do you want to see the fingerprints on the crime scene? Look at the vault logs from today. We just received the daily vault activity report for the COMEX. Look at this line item. 1.96 million ounces out from JPM. This metal was removed from the eligible category. Eligible means metal that is sitting in the vault, owned by someone but not registered for delivery. It's essentially private storage. JP Morgan just raided their own private stash for nearly 2 million ounces in a single day. Why? Why are they draining their own reserves? Because they are scraping the bottom of the barrel to pay back the Chinese. They are looking under the sofa cushions for loose change. And look at the platinum shenanigans reported in the same data. A massive drop in open interest overnight with no price movement. That is the hallmark of exchange for physical, EFP transactions. That is the banks taking trades off the books into private settlement because they are terrified of what will happen if those trades hit the lit market. They are hiding the demand, they are hiding the shortage, but they can't hide the price. Visual, the chart again, 67.17 blinking. The Fibonacci lines are drawn, $73, $80, $89. The options market smells blood. We are looking at the open interest for February 2026. That's just a month away. The smart money is piling into call options. There are 7,104 contracts targeting $80 silver. There are 6,146 contracts targeting $85 silver. These aren't lottery tickets anymore. These are calculated bets by insiders who know about the lease expiration. They know that in early January, JPM has to buy or die. And if JPM has to enter the open market to buy 129 million ounces, $80 isn't a target. $80 is a speed bump on the way to triple digits. We have established the why. Samsung needs it. JP Morgan owes it. The physical market is breaking. Now we need to talk about the when. If you think this move to $67 feels fast, you haven't looked at the math. We are witnessing a phenomenon called Fibonacci acceleration. Look at the time it takes for silver to break through key resistance levels. It's not just going up, it's speeding up. $13 level, it took 60 months to clear this base, 5 years of grinding. $21 level, it took 45 months to break out. The window is shrinking. $34 level, it took just 15 months. $55 level, it took only 5 months. Do you see the pattern? 60, 45, 15, 5? The time between every major price explosion is collapsing. We are entering the vertical phase. According to this mathematical sequence, the move we are in right now, the move from $55 to the next major Fibonacci target of $89, should not take months. It should take weeks. And what happens at $80? There is no resistance. There is no historical ceiling. $89 is blue sky. Once we clear that level, the next mathematical target on the Fibonacci extension is $144. This matches perfectly with the option market data we discussed in part 1. The traders betting on $80 and $85 for February aren't gambling. They are simply following the acceleration curve. But math is one thing, geopolitics is another, and right now the geopolitical chessboard is screaming checkmate. While we stare at charts in New York, the real price is being discovered 7,000 miles away. For the last 3 months, we have seen a persistent, undeniable signal: the Shanghai premium. Silver in China is consistently trading $2 to $3 higher than silver in New York or London. In a functioning market, this shouldn't happen. Arbitrage traders would buy the cheap silver in New York, ship it to Shanghai, and pocket the difference. That activity would close the gap. But the gap isn't closing, it's widening. Why? Because you cannot ship what you cannot get. The fact that this premium exists proves that the metal in the West is either leased out, like the JP Morgan ICBC deal, or simply doesn't exist in deliverable form. The arbitrage is broken because the physical bridge has collapsed. And China isn't just buying metal, they are building a new financial system on top of it. We have reported before on the unit, the proposed BRICS currency. The white papers are public. The plan is clear. A currency backed 40% by gold and 60% by a basket of local currencies. But here's what people miss. You cannot build a gold-backed system without silver. Silver is the industrial engine that powers the gold-backed economy. China knows that if they control the physical supply of silver, they hold a veto power over the Western green transition. They can turn off the supply of solar panels to Europe. They can starve the US EV market of batteries. This is why Samsung is terrified. This is why they are paying $7 million to restart a mine in Mexico. They are trying to secure a supply chain that isn't dependent on Beijing. So, where does this leave you? We are sitting at $67.17, all-time highs. It feels expensive. It feels scary to buy here. But ask yourself this: is it expensive compared to what? Is it expensive compared to the dollar, which is being printed into oblivion? Is it expensive compared to Samsung, who is willing to buy an entire mine just to get it? Is it expensive compared to JP Morgan, who needs 129 million ounces in 2 weeks or face default? We are transitioning from an era of trading to an era of hoarding. For 40 years, you bought silver to sell it later for a profit. In 2026, you will buy silver simply so you have it. The Samsung deal is the signal. The smart money has left the casino. They are no longer betting on price direction. They are securing physical inventory. If you are sitting on the sidelines waiting for a pullback to $50, you are fighting the Fibonacci sequence. You are fighting the Shanghai premium. You are fighting Samsung, and you will likely lose. My analysis is simple. The $73 level is the next door to kick down. Once that breaks, the vacuum up to $89 will be violent. The window to exchange your paper currency for a strategic metal is closing, not because the price is too high, but because the sold out signs are coming. Samsung got their mine. JP Morgan is raiding their vaults. What are you doing? We at Currency Archive want to thank you for being part of this movement.